Well, it's with great pleasure that I see you all today, and I'm glad you can join me. My name is Gary Fowler, and I'm a serial entrepreneur. I've done 17 companies, been involved in two unicorns, Click Software and Eva.ai, which is an AI HR tech company. I love artificial intelligence and quantum computing, and today I'm the CEO, president, and co-founder of GSD Venture Studios, a premier AI and quantum venture studio located in Silicon Valley. So, with that, it is my honor to introduce Suri. So, Suri, I want to make sure Konanuru, yeah, Konanuru. Make sure
Konanuru. It's like Conan and you are you. Uru.
got it. Konanuru.
Yeah.
So I just, it's incredible. So you're the CTO of Idea Spring Capital. You graduated from IIT. You've had quite a journey from projects to where you are today. So you're currently the CTO of Idea Spring, a venture fund, and you built compilers and networking software in Ripro for almost a decade. And then you started into startups in 1999 and co-founded Alopa Networks.
Mhm.
So what is it like? I mean, it's like, how do you go from doing projects and building compilers for Wipro to where you are today? How does that work?
See, it's all tech play, right? Finally, like I'm still a technologist. Okay, that's how I look at it. See, in Wipro was a product company when I joined. We had an R&D of 100 people building system software mostly and hardware. And I was actually like building compilers, COBOL compiler for the hardware, which was done by Wipro, right? And in those days, like in the early 90s, when many of these companies, right, like we were used to build hardware, software, and sell to the Indian market. But with more and more liberalization, right, those businesses became a bit not so interesting, you can say, right? So Wipro started actually like utilizing the R&D capabilities, right, as an R&D on hire, R&D lab on hire, right, for companies in the US. And I went to Intel, and I was part of the Intel's compiler group for some time, building C compilers, okay, and things like that. But still, actually, we were building software for Wipro, but we started building products for other, basically like the companies like UB Networks and Intel and those companies, right? So we're still building products. The only thing is, those companies used to tell us what to build. Okay, so that's the change, right? So,
Yeah.
but building. So I would actually say the difference between services and product companies is basically somebody gives you the requirement and somebody actually sells it. Otherwise, it's the same. Like the in between steps are the same. So what happened was like we were building these products and all those things, and then in 99, actually about 2 years before that, like 96, 97, Wipro decided to build products again, because we had that in our blood, right? Building products. So we built the world's first web-based network management software within Wipro. And then when the whole company is doing services and then you're a small group building products, right? It's not very easy, right? So that's when we all decided to actually come out and actually build this Alopa networks. Or we never used to call it as startups also, because those days we started a company. Like there was no concept of startups in India. It wasn't well known at all, and there were no angel investors. There was it was a very, very different world those days. So that's how Alopa happened.
And what happened to Alopa? Where is it today? I know you were there until 2004. Where is it today?
So we got acquired. We actually so we built broadband provisioning software for cable modems and basically the ISPs in US. So most of our customers used to be in US and Europe. I used to work out of California at that time. And in 2004, we got acquired by a company called Secor.
Is it Secor from State College, Pennsylvania?
Yes.
Oh, that's amazing. Yes. I actually lived in State College. So the guy that ran it, Dave Woodle.
Secor acquired us, and Secor was acquired by Aris. And I think now many of my colleagues are working in ComScope.
Wow, is it a small world? It's amazing, actually.
Yeah.
So I remember the guy. Do you remember Dave Woodle? He
Yes.
CEO,
Yes.
and
Yes.
over from HRB Systems. I knew Dave when he was the program manager, actually vice president at HRB. It's a small world. That's amazing. I saw
Yeah.
it on your CV. I thought that can't be. It's got to be something else. So interesting. I got a question for you, sir. How is it living in Bangalore? What's it like there?
So you want me to compare Bangalore when in the 90s? See, okay, let me tell you this. Like I came to US first time in the 90s, right? So there was a huge difference in the sense of whether it comes to the kind of food you get, and we had very less exposure to the US, right? So everything was new, right? So now it's not so much, basically in the sense that the world itself has become like smaller, you can say, in that way, right? So it's similar to see there are some things which are tough in India. Okay, let me tell you that. But otherwise, the kind of exposure you get, the kind of people you work with, that's all like very similar to what I used to see in the US. But we learned a lot in the from working in the US because it can be processes, it can be the new tools, like, or it can be the way you approach customers, work with people from other cultures, right? So those exposures you don't get so much in India, I would say, because you're still like even though it's cosmopolitan, like there are people from all over India who come and work in Bangalore. People should work in US at least for some time to get that exposure. Yeah.
No, it's interesting, and I've worked with a lot of Indian engineers, and I've been on management teams with Indian executives, and it's incredible. So it's fascinating to me because I remember a long time ago people were talking about Bangalore, and now like Bangalore's a diamond, and an incredible innovation comes out of there. So
Yes.
but that's the way it works, right? I mean,
Yeah, we are the third largest startup ecosystem in the world today.
it's amazing. No, hats off. So you did Alopa, and then you came over. So you doing early stage investing right now? What kind of companies, and how big is the fund? What are you doing exactly?
See, we launched our fund in the middle of 2016. We are a 20 million fund. We are a very small fund. Okay. So we invest in early stage B2B product innovation startups. So a couple of reasons for that. Basically, like in middle of 2015, when we started thinking about Idea Spring Capital, there were very few, or there was no early stage fund investing completely in B2B product innovation startups. People used to invest in B2B, but that's as you get the opportunity, right? There was no most of them and everybody used to invest in B2C, and it continues. But the thing is the amount of money and the number of startups in B2B has actually gone up from about like 28% in 2014 to actually about like 43% now. So basically like of the total startups. So there is a trend where there are more B2B startups. And if you see in the last couple of years, there have been also been unicorns in B2B, which was unknown like before, right? So, and we invest usually like when the company has an MVP and has some customer validation. So we have, out of the 16 investments we have done so far, we have led 12 of them, and about 10 of them were pre-revenue. So we come in really, really early. Okay.
And then how big are the checks? How big are the check sizes that you write?
So usually we invest about 500K to 1 million, and we work with the startups and we co-invest another 750K when the company comes to pre-series A, series A stage. So right now from fund one, we have invested in 16 startups. We are in the process of raising our second fund, which will be double in size. So, and so that we can give more money and give more time for
And
these
how big
startups.
is that fund going to be? What's the size
That's
of it?
going to be like 35 to 40 million USD.
Okay. Wow.
Yeah.
So that's great. Congratulations. And how about the companies you invested in? Can you tell us about some of the success stories?
Yeah, see, out of 16 investments so far, four of them are doing upwards of 2 million ARR in the last like 3.5 years. See, and the overall, if you take all the startups together, right? So our portfolio has grown 12x in revenues and 6x in employees and 8x in customers. So that's the kind of growth we have actually like done, and we had 3 exits, and like 4 of them are doing more than 2 million ARR, and another 4 to 5 are doing like 300 to 500K.
Now, when so you have these companies there, what do you look for, sir, when you're going in, like at the companies? What, so if you take the 3 top characteristics of the startups, what do you look for? What really trips your trigger and you say, I'm really interested in this company because of?
Yeah. See, see, everybody has the same answer. So let me just actually like instead of 3, let me tell you a couple more maybe, right? So as you know, like team is the one constant thing in any startup, right? You may pivot to do something else, you may pivot to another market and things like that, but you would like the team to stay. So that's why team. And then actually like what is the problem, market size, those things everybody looks at, right? So for us,
sorry, I want to interrupt you for a second. So let me drill down on this team thing. Right. And I believe, so what exact characteristics? So if you look at a CEO of the company, what are you looking for in that CEO and the management team that you can say, I feel confident in that my money's going to do the right thing. No matter what happens, they'll do the right thing. What do you look for?
see, so most of the startups we invest in, they all are tech guys. Okay, so we see like okay, what domain expertise they have, right? That's one thing, and also like how complete is the team. Many times it won't be complete because like most of the tech guys and there'll be a CEO and a CTO, basically like the tech guy trying to become a CEO, right? Like that's the usual situation, right? And they may not have a sales team yet, right? Because we come in quite early. So we try to look at like, okay, what is the domain expertise they have and how tough is that problem they're trying to solve? Like how big is always there, but because we look for those technology differentiation, right? So that's very important for us because since we invest in tech companies, we want to see what is that they're doing differently.
Right.
So that's a very important thing. And when it comes to say very early stage funds like us, which is small in size, right? Timing also is very important because we can't really pump in a lot of money to them, right? So we have to see like how soon they will get their solution get adopted and they start making some revenue so that we can go for the second round. Yeah.
Now, do they have to have revenues for you to invest? Or
No. Actually, out of 16 investments, about 10 of them didn't have any revenue.
How
And
close,
actually,
how close were they to revenue when you invested in them?
they had MVP and some people were using it so that we could get some feedback. But there are a couple of companies where the product is still being built.
What about doing their customer development and customer discovery? Do you ask them questions and probe them about that? What are they doing with customer discovery and customer development? Have they made sure that the market wants their product?
Yeah, see, there are a lot of times in our diligence itself, like basically, like we are quite well connected in the B2B space just because I worked for so long, right? Like myself, Naganan, we all have worked in the B2B space. So before we invest, we usually have some connect from where we take those helps. And also, like we most of the times, what we do is we put the startup in front of a probable customer, right? So that brings out a lot of things in the sense that you will understand, okay, how are they solving the real problem, right? That's the most important thing because you can have like a kick-ass tech and everything, but like if you're not solving a problem, nobody is going to pay you any money, right? So you're not going to be a viable business. So a lot of times we do that as an exercise where we put them in front of a probable customer whom we know well, and actually we get some good feedback.
You test them out, huh?
Yeah, but the thing is, but the thing is, like it has helped some of the companies where we didn't invest, but they got a customer.
That's great, and it's a good test. And
Yes.
what I've done, what we did with Eva when I co-founded Eva with David Yang, what we did is we went actually out and we would go to cafes. We walked down the streets in Palo Alto. We would pick people up that were having a drink or coffee or whatever, and we would start customer development with them. And I would actually put up my notebook and actually do a presentation, and I would have the camera there to get their feedback. And it proved invaluable. Really, I understood right there and then. We had to pivot 3 times, that we had a great product and a great service, but the problem is people weren't willing to spend money for it.
Yes, yes, yeah. Because lot of times that's what happens, right? Like people build something and go in search of a problem. So that shouldn't happen, right? So that's the main thing.
So your fund's going to double. What about with your companies going global? Where are you with that, sir? In terms of, are you just focused on the Indian market, or are you looking at other markets? Will you invest in a company in Europe, or are you mandated to stay in India?
So no, actually, see, we even in our current fund, we have two companies which are Bay Area based. We have co-invested with others in Bay Area. So one of them, which was Panago, which actually got acquired by IBM recently. Okay, and we invest in companies which has at least some representation in India. It can be the development team, right? That's also fine. So we are investing in startups which are solving a global problem. Like they start off in India, but like their whole goal is to actually go global. And some of our companies like Karomi, Voxogo, and Lavel, they are actually like going global. Actually, they have customers outside India also. Okay, already. And then there are some of the new investments which we still haven't announced. They're actually SaaS startups, and they actually have customers already in the US. And another company which actually called Bugle, which actually has an NLP startup, which actually analyzes unstructured data to give product insights, category insights, and competition insights. Right? They already have customers in Europe and US.
Interesting. Now, do they keep their headquarters in India if they're an Indian startup, or do you move them to Silicon Valley? How does that work? Or Europe? How does it work?
See, it has worked both ways. Okay, we have companies who have headquarters in the US and development team here, and we also have companies who are headquartered in India but have an office in the US for sales and marketing. Both ways. So see now finally it doesn't matter, right? Basically, like in some cases it matters, but like now there is more investment coming to India also from the US, like so things like that, right? So it all depends on what you want to do, right? And some of the companies would like to flip. That also is happening, but like in India there is a momentum gaining where people want to actually have more investments in the Indian companies also. So.
What about the valuations? How are the valuations? I know, in the Valley, one of the things I can tell you from my company, which had roots in Eastern Europe, and we moved it over to the Valley, that the valuations are dramatically higher. Is it the same with the Indian companies, or how are the valuations, let's say, of Indian companies, an AI company today versus 3 years ago? What's the value? What do the valuations look like?
See, valuations are increasing, but the thing is, see, take a look at it from a fund like us, right? So basically, like we come in so early, it's not so easy to actually put a value, right? Because they may just have a product, right?
That's your secret. Get in early, understand what you're doing, and get in on bet on the come.
Yeah. So the thing is like, and for the amount of effort we put in with each of these startups, we would like to have some sizable equity, right? So that's how we look at it, because we invest only in about 4 to 5 startups per year, because we actually like become almost like part of those teams, trying to help them in whichever way we can, right? So and we come in so early when many of them don't have revenues, and many of them don't. Some of them don't have products also, right? So usually
even with an idea.
Not just an idea, they might have done some research. There is one startup which called Simyog, which is an IISc startup. IISc is like IIT, right? Okay, like it's a premier institutions. And one of the professors from there, after doing 4 to 5 years of research, he started off this startup. And as you know, like, see, the thing is, a collaboration between academia and industry and startups, and that's the best to actually do something really great work, right? So these guys actually can simulate AMI, AMC issues from the design, electronic design. So electronic design can become as agile as software. Okay, so that's the kind of thing they're trying to do, right? And they have like companies like Panasonic and in Japan, right, as their customer, Denso as TI as their customer. For a startup at such early stage, it's great to have
No,
that.
that's great. Sounds like that's a good bet. So what about having, we look at mixed teams. So we look at marketing, technology, and
Mhm.
operations many times. What do you think about mixed teams? Because one of the things I found, especially in Silicon Valley, is that you can have great technologists, but if they can't make the transition to leadership positions in the company and they don't
Mhm.
understand marketing and sales, the company never goes anywhere. We say it's like having a Ferrari in the garage, right? What do you think about that?
Yeah, see, the thing is like this is something which happens with many startups, right? Like I think even in the valley, in the sense that like when the technology guys they have to step up or they have to bring in people from outside, and there have been cases where we have brought in like salespeople from outside to actually like help out the and it takes some effort and maybe a couple of years for a tech guy to become a pure CEO, right? Because it's not so easy. Basically, like because you still think technical, right? So that's what happens, right? So, but as a startup, as you know, like they have to step up or they have to bring in people to help them out.
Yeah, well, I
That's
mean, you
the
150, 200 people, a lot of times the executive team shifts, right? Once you start to really load it up, because operating a company at that kind of level, Series B plus, is a lot different than doing an early stage startup. Now I got it. Coming to the top of the hour, Suri. So I wanted to say, what are some final thoughts from your perspective? What advice can you give entrepreneurs and startups, as we look forward to 2021 and the future ahead of us? What kind of tips can you give the startups and investors that are out there? And also, how do they get a hold of you?
Yeah, I'll answer the easy one first. They can get hold of me on LinkedIn or Surya at ideaspringcap.com. They can send me an email and I'll usually respond. And advice wise, okay, basically like 2020 has been quite troublesome, right, for everybody, right? Basically, like so during that, I always used to tell all these our startups and whoever I meet as to strengthen the product because this is when they get all the time to actually strengthen the product because the market is bit down and things like that. But the market will come back, and there are new opportunities. As you just have to actually like survive, right? And so that you can thrive when the market comes back and when the customers start buying again, and that's already happening. Actually, like unless actually and there were companies which actually repositioned their product right to suit the COVID situation and COVID is bad, was bad and everything. But like I agree with all those things. But the thing is, but it also brought in a lot of opportunities for health tech companies, right? Med tech companies, life sciences companies, and
Absolutely.
and 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 uh, and lot more. Basically, like like basically like clean tech. Like, there are more opportunities also which actually came out of this, right? So we have to start looking at the positive side of things also and just hold on and then survive, right? So
I agree. I had a guy who's a extremely successful an investor from Europe. Per Wimmer works a lot with Richard Branson and and my friend Peter Plout, and it was amazing. He said one of the things when you're going down through and building a company or building an investment firm is positivity and look at the positive side of it and not focusing on the negative side. Visualize where you want to go. And this guy jumped over Mount Everest as a tandem parachutist. So he's pushing it. And
see the way I look at it, not just in startups, like there are things which are like not in your control. Okay, so you just have to control whatever you can control, and then and time will change, right? So that's the way you look at it.
yeah,
Do
he
whatever you are doing currently the best way you
I
can.
rate your risk. I do an analysis of the risk. I said, now tell me, how did you come up with the thing, the parachute over Mount Everest? I mean, I don't know, maybe just me, but that seems like that's pretty risky. Well, I had the right equipment and that kind of thing. I said, but it's still kind of risky. Anyhow, I really appreciate taking your time out of your busy schedule. Thank you for joining my show, and
Thank you for hosting
look
me.
forward to
Yeah.
working with you and speaking to you in the future. Thank you very much, sir. It's
Thank you,
appreciated.
Gary. Thank you.
Okay, stay tuned for part 2 of the show. Thank
Sure.
you. All right, Eddie, great to see you today.
Good morning, Gary. Hello, everyone.
Yeah,
Thanks for having me.
Thank you for joining the show. It's with a great honor and privilege. I really appreciate taking the time out of your busy schedule. So, Eddie's a partner at Vantage Venture and an early investor in B2B SaaS founders. You do. I know you as a judge and mentor in an ecosystem, and incredible background. Everything from University of Pennsylvania to building groups. University of Oxford, and applied statistics, Eddie?
Yes.
So you know about Man Whitney U and ANOVA and all that. That's incredible. I actually took a few of those courses myself. But so if you look at what's going on today, Eddie, you've got a phenomenal, a very mixed background, and it's as an early investor and a strategy officer. What kind of things are you looking at today? And I know we talk about SPACs and I want to dive into it, but what kind of things are you looking at and how's your journey been?
Yeah. Thanks for asking. So, people have said that I am rather eclectic in nature. So eclectic just means somebody with diverse interests and passion. So the good news about startup investing, at least in the very early stage, is that I don't use statistics at all. It's very much based on the founding team, their passion, their commitment, and their determination. Just like cockroach, the ability to survive. That's the most important. Last year was very interesting.
Eddie, I've never heard that before. I got to tell you, the whole start. I've been in startup for 30 years, but like a cockroach, willing to survive.
Yes.
That's and you're right. That's about it. And if you have an obstacle, to move around it.
Yes. Cockroaches are very versatile creatures in Southeast Asia because of the climate. In different parts of the world, so some can swim, some can fly. They do what it takes to survive. There's even a venture building firm also called similar. Okay, yeah. Last year was interesting for many investors and for many founders. Nobody has expected the COVID to come, and today the COVID is here to stay. So even my university, Oxford, they came up with a vaccine, not the best in class, but better something than nothing. And it was meant for emerging markets. So I'm very happy to see that even my university can be agile to create products, vaccine to serve the emerging markets. So that's pretty much, so that's something important to me. I am also a former World Bank consultant in Southeast Asia, especially in Vietnam. So to me, serving the disadvantaged, the privileged is very important, which is why when I look for founders, I look for those founders which are disadvantaged, and yet they have superpowers. Superpowers can mean their relationship, their coding skills, and whatnot. So,
Eddie, what does disadvantage mean? Tell me about that. What is I'm curious. I grew up on a farm in Pennsylvania on the side of a mountain. We had 500 people in my village. We had cows, we had corn, we had pigs, we had all kinds of things. I don't know if that's advantaged or disadvantaged, but what exactly does it mean? It's interesting.
Yeah. So in my view, in your case, if you are a stock market investor, you can be very distant from a lot of noises in the market than say if you are based out of the Wall Street. That's what happened to Warren Buffett with Berkshire. For me, I look for founders with a disadvantage, and they recognize it, and they have a chip on the shoulder, meaning to say they want to prove to the world, they want to prove to their family that that there's a pain point that they've identified with a large market which they have a unique approach to solve. And that's where people like me come in to say, hey, let's partner up. Let's take it from pre-seed to seed and beyond, and hopefully to a SPAC or to an IPO. And these days, SPAC can come in different shape and sizes, not just for unicorns, even the pre-unicorns and whatnot. It's just a funding angle. Yeah.
Yeah. So tell me a little bit about, because, not everybody understands this back. So, I mean, can you give it, because I have a very, very wide audience around the world. Yeah. Can you explain in simple terms what a SPAC is and how it would, what kind of startups would fit into a SPAC, and how do they go about it? It'd be interesting.
Yeah, great question. To me, so SPAC stands for Special Purpose Acquisition Company. In simple terms, this means a young startup turning public by acquiring a listed cash shell, typically in the New York Stock Exchange. But I think that will evolve to Europe and Asia as the regulations change. The stock market now is booming so far due to zero interest rate, negative interest rate environment in many countries. That's one. Two is there's a lot of private equity funding that is available and hungry to back up and coming technology startups, such as in AI, in electric vehicles, and whatnot. So great examples of companies that have become listed last year can include Palantir, for instance.
Yeah, here's a big Eddie. How much revenue does a company have to have? So here's a picture. If a company has an MVP, they've got a couple $100,000 in revenue. Is that a SPAC opportunity, or how do you evaluate what revenue level they need to have so they come in and talk to somebody like yourself?
That would be too early to do a SPAC. Yeah. Let's not talk about US, because in US the SPACs are much bigger. So take for example, when a famous person or a famous investment banker or a famous politician, okay, anybody, they want to launch a cash shell and list it on the New York Stock Exchange. Let's start simple. Let's say this person managed to raise $100 million and list the cash shell on New York Stock Exchange. This means this entity has up to 3 times the firepower to acquire a startup that is worth up to 300 million in valuation. So this is a very small SPAC in the US context. So typically the SPACs, they raise up to 1 billion, 2 billion, 3 billion, especially like the biggest would be Bill Ackman from Pershing Square. So he raised about 3B. So that means he can take on a decacorn if he wants to, because of additional funding like pipes and whatnot. Away from US, many young startups, they may be in the Series B, Series C stage. They will also be eligible to do a SPAC. Smaller, let's call them micro SPACs, if you like, or nano SPACs.
Wait a minute.
And why do startups do that? Yeah, and you ask, why do startups do that? The reason is because the valuation is much better, more founder friendly when you're a listed entity in this market right now. Than if a founder tries to raise additional VC money or PE money in the private markets. That's how the market dynamic works at this juncture. Yeah.
Interesting. So I was going to ask you the question. I've never heard the term nanospec ever. It's the first time. Did you just make it up, or where did you come out with this? Amazing.
I try to use analogy so that it's easier for people to resonate. A SPAC is nothing more than raising another venture round just like 3 years ago, it used to be called a SoftBank IPO until we know what happened to WeWork. Yeah, that didn't take off. After that, came the SPACs. So it's just another phenomenon for founders to raise venture funding to further scale the business. And the interesting is this: sometimes these are pre-revenue companies, although they are at unicorn status. Yes, so many of them. If you look at the electric car market, now I'm not an electric car person, yeah, but I do follow Tesla, yeah. So Elon Musk is one of my idols. Last year, there are so many electric vehicle company pre-revenue with a great story. They reach unicorn status. Some have done well, many have not. So that's for investors to determine which is good, which is not. But this further support the fact that there is money looking to back great founders with a great story to scale the business and eventually to deliver great outcomes. So that's the whole point.
I got it. Okay, understood. And you said micro SPAC too. What's the difference between a nano and a micro?
Yeah, a nano is smaller than a micro SPAC. Yeah. So myself, I'm a partner at Vantage. We are very early stage investors, pre-seed and seed. Typically, our ticket size is up to 200,000. Sometimes we can touch 1 million. We are backed by family office. So this means that we have permanent capital. So the interesting thing is, although I am an early stage investor, I do see opportunities whereby some of my investees, if they tick the boxes, if they have the prerequisites, they are also eligible for SPACs. Not necessarily in the US, yeah, but this means an exit, a great outcome, liquidity, and whatnot. So I think that's interesting.
No, it's very interesting. So, can you do me a favor? You know, people talk about family offices all the time, and you know, I know a bit about it, but just for my audience, tell them what a family office is. Is this like the Rockefellers, or I mean, what is a family office? What does it consisted of, and what are the differences between them?
Great example. So the Rockefeller family is a pioneer in family offices. Correct. So these days, the standard definition of family office will be a well-to-do family, yeah, or an individual. We can call them ultra high net worth individuals. So usually a family office needs to have about 30 million up to 100 million or 1 billion in assets. So typically a family office is structured to manage the investment activities of a certain family. If it's a single family, it can be the Fowler family. Or it can be a multi-family, such as the Fowler and the Lur family. No problem. Yeah. So the family office will then identify investment opportunities in both the public markets and also the private markets. So if a family office is well diversified, then typically 3 to 5% of the assets will be allocated to alternative investments, and that means private equity and to some small extent venture capital. There's a trend of family offices becoming direct investors as opposed to just investing indirectly into VC funds, PE funds. Direct investments means they take on a more proactive approach to source, structure, and to do value creation for their investees, pretty much like how VCs and PEs do. And they can do that because there are a lot of investment bankers, they have moved on to look for new opportunities, especially with the family offices. So the lines have been blurred between the private equity VC investors and the family offices. It's just a label. Look at point 72.
Yeah.
What are they? Are they a hedge fund? Are they a family office? Are they a VC fund? It's in or around that. It is everything actually.
So how do you get to? So you know, somebody was asking me, how do you get to these family offices? It's like the secret squirrel society. Where do you? I mean, and I, you know, I'm down in Palm Beach, so a lot of high net worth folks around. But how, I mean, you can go to the country club, but how do you like get on the radar screen? I know on the VC side, how do you get on the radar screen of these family offices?
Yeah, great question. So there are a few kinds of family offices. There is the first generation money, whereby the founders have retired. Yeah. So they tend to be rather conservative because it's for asset protection. Now, these are not the kind of family offices I will go for, because their intention is more to put money into bonds, very, very sleepy instruments like 3 to 5% a year, and they're happy. I go for the second generation family offices. What does this mean? So these are managed by younger people, perhaps from inherited wealth, and they have a different mindset. They look at tech investments. They want to do direct investments. They want to be very hands-on. They want to exchange deal flows, and they want to act as a strategic. They want to act as a financial investor. And the great thing is they have got permanent capital. If you look at every VC fund, typically it's a 10 years plus 2 years option, sometimes shorter. So when you're a VC and you've reached like 1/3 of your fund life, this means you have very little time to invest and to do value creation and extraction. That sucks for the founder. Yeah. But when you have capital that is backed by family office and you'll be around for the next 20, 30, 40 years, you know that you have time to grow your business in a way that is enduring, sustainable, rather than just burn money, burn cash, and make tons of mistakes. Sure, look, all founders make mistakes, but what is important is to have patient money, which are value added to help you grow the business such that you can be the next great company.
So I know a couple of, I was actually excited because I actually met a couple of, I didn't realize that the family office, that the person I was talking to was the heir to the family, and a quite wealthy family that was actually doing the investments. I've had it happen several times actually. But how good are most of the family offices in terms of understanding like tech, right? Do they understand, what they should be investing in or not? Or is it kind of like a trial and error with them? How does it work? Are they really grounded from your experience?
It's a mixed bag. Usually I will ask them about their investment experience with startups. If the family officers have prior experience with brick and mortar companies, sweatshop companies, that is not the right fit. So if their portfolio companies are more tech related, and they can prove that they have added value to their investees, I think that's a great starting point. In Southeast Asia, I've seen some family offices, they become VCs themselves. And what this means is they use the seed capital from their family members, and then they institutionalize it, and then and start to originate investments. Sometimes they will co-lead, and then they'll partner up with other VCs as well. So this is the kind where I think they're more avant-garde, and they're definitely contributing to the ecosystem. Family offices, of course, they have their brands as well. Certain family offices, they are known maybe for in different verticals. It can be in manufacturing, it can be in F&B, it can be in airlines, and they will have their own specialty and their value add to bring. When it comes to the so-called heir to the family empire, I will ask which one, because typically these families may be a little bit complicated. Sometimes the family is big, there are many heirs, and there are people masquerading as heirs, and whatnot. So it's important to have a clear idea of whether the money will be put on the balance sheet of the vehicle, or it is just investing based out of somebody else's pocket that you can just take out 10 million or 20. It's important. Take for instance, in the Middle East, everyone has a family office. Every sheikh means every prince has a family office, and everyone and there's a ranking to such royalty as well. So in the Middle East, I refer to the GCC. To those who do not know where is GCC, it is it is in the rich part of the Middle East, including like Saudi Arabia, in Abu Dhabi, in Qatar, in Dubai. These are great sources of family offices
Mm-hmm.
With connections to the royalty or their royalty themselves. But
Mm-hmm.
everyone is a royalty. Then you could then find out the ranking and whatnot, and therefore the kind of political advantages they can bring for your business or for your investees. I have worked for 4 years in Qatar, so I bring up the Middle East as well. That's how eclectic I am.
Wow, that's amazing. So, and again to the question. So let's say we got a startup from Singapore or startup from the US, and they say, I want I want to meet some family offices. Where do they meet them? How do they come? I mean, I've met them on different events and panels, etc. But it's not so easy, and it takes a while to really figure out who they are, because many times they're not. When they come on a panel, they're not who they say they are. They're much deeper, and well, I'm actually the heir to the money. They don't say that, but you've got to figure it out, right? How does it work? Where do you find them? Are they in competitions, or is there a guide that says the family office guide? Pitch to family offices. How do you get to them?
My 2 cents worth is from word of mouth. So usually family offices, they are quite mysterious. So most of the times they won't appear on events. If they do, it will usually be an investment manager that is representing them. I mentioned word of mouth is because at the end of the day, we are in the business of investing. We're in the business of generating returns. So word of mouth means people who trust us, who believe in our track record and our value add. They bring investors to the table and say, hey, let's meet, let's talk. It always starts with a date. Don't marry anybody on the first date. It's about building a relationship. It definitely takes time to nurture relationships with investors, whether they are family offices or high net worth individuals. But the great thing is it becomes very sticky. Once you have demonstrated the value add and the track record, these relationships can become can be formed for many years, and that forms the foundation for permanent capital to use to invest into great founders, pre-seed, seed stage, and whatnot, and maybe even do SPACs.
No, it's interesting. It's like I said, it does take a while to warm them up and develop the relationship and rapport, and yeah, it's amazing. But once you get in, it's really interesting because one gets you two gets you four. They start to come in because they know that you've had success, and they want to be, they want to play in the reindeer game. So it's really interesting how it works. I know we get a lot of people, a number of family offices reach out to us regularly and looking for AI and quantum opportunities. And I've developed some good relationships actually with a few of them. That's interesting. So what do you see in terms of the SPACs? Where's it going to go over the next year? Do you think it's going to go up? Do you think it's going to go down? What's your opinion for 2021?
Do you mean SPACs?
Yeah.
Yeah. From a macro perspective, the interest rates globally will still be low, zero, or negative. What this means is that there is a shift in appetite towards risk assets, such as in private equity or in venture capital investments. And the public market right now is very warm towards SPACs and tech IPOs. A little bit warm, in fact. Some people, some investment bankers, they are saying that it's too bubbly. But guess what? These are the same investment bankers who are underwriting the SPAC deals and doing the SPACing. Correct. I don't want to name names, but you will hear like bulge bracket investment bankers. They're calling out to say it's a bubble. Why? Because they are helping their client, which is the SPAC, to merge with a tech startup, and they're asking for sky-high valuation. So there are like more than 200 SPACs known in the US right now. They started raising 2 years ago or 1 year. And typically a SPAC has about 2 years to identify an investment to merge, acquire, before you do a redemption. So what does this mean? Between this year to next year, you're going to see a wave of SPAC mergers in the tech space. These are typically the unicorns or the decacorns or the pre-unicorns. And it is for investors to be aware, to be careful of what kind of deals they're getting into.
Mhm.
So, as with any investments, it's important to know who the promoters are and
Mhm.
to look at their track record.
I got it. Interesting.
I'm not here to promote SPACs. I'm not here to slam SPACs. Everyone has their own view.
Mhm.
Yeah, it is just a phenomenon whereby founders they have an additional channel to raise funding and probably go public when they have to, especially when they reach 10-year mark, 12 years mark. Even in Southeast Asia, the biggest unicorn, decacorn, will be Grab. Grab Group. They do ride hailing, they do financial services, fintech, and whatnot. At this juncture,
Mhm.
it is also publicly known that they are exploring to do a SPAC. So this will take them to maybe like 15 billion,
Wow.
and this will be from New York, and they're backed by the biggest investors you can see. Everyone wants an exit, right?
Mhm.
Yeah, and they're of course not close to profitability yet. That's after like so many years.
Wait a
So
minute.
for sure,
15
profitability is
billion?
yeah, for sure profitability is not a prerequisite.
Uh-huh.
But as we know from the Uber experience, you do need to show a path towards profitability within 3 years. Otherwise, Dara will be out of job.
Mhm.
Yeah. So yeah.
No, it's interesting. We're coming to the top of the hour. So, what are your closing thoughts? For entrepreneurs and investors, closing thoughts, and where can people reach you?
Yeah, in the post-COVID world which we're in, and there'll be many variation of COVIDs coming up, COVID 1, 2, 3, 20, 100. I think this is a great opportunity for founders to develop, scale their ideas, which are more remote, which requires AI, which are for remote education, for remote living. And the great news is there's a ton of capital waiting to back great founders, especially those with unfair advantage and a chip on the shoulder. And in this world right now, I believe that founders have a great opportunity to excel because tech investments are widely recognized now. So being a founder many years ago used to be uh, a smaller part of the business world, but right now it is very recognized in Asia, in Europe, that founders are necessary in order to grow the SME segment, to grow the technology segment, to boost the economy. Even for the governments that I've seen in Singapore, in Southeast Asia, they're all supporting tech startups to the extent they can because they want to generate jobs.
Mm-hmm.
Whether they pay tax or not is a different question. But when you can generate jobs, you're adding value to the economy. Everybody wants to help you, and I hope that early stage investors like myself, we have a chance to also back more wonderful founders to add value to the economy and bring benefits to the investors.
No, that's great. I want to say thank you for taking time out of your busy schedule one more time to join us today and appreciate your amazing thoughts and direction. Appreciate it. There's some amazing insights that you gave us today and look forward to speaking to you again soon. So thank you very much.
Thank you very much, Gary. Thank
All
you.
right.
Have a good day.
Take care. So I want to just thank everybody for joining us today. This was another incredible session with Suri and Eddie, and we look forward to seeing you again next week on GSD Presents Silicon Valley AI and Tech. Remember, AI is the new electricity, and quantum computers and quantum computing rolls. So with that, my name's Gary Fowler, and I'm your host. See you again next week, and have an amazing day. Bye-bye.